Morning, everyone. Welcome to Healthcare Lending in a COVID and post-COVID world. We appreciate you joining us today. I'm John Tischler, a partner in the Finance and Restructuring Group at Waller, which I'm personally based in Nashville. We are now in year 2 of the COVID pandemic in America, and the pandemic has had a devastating effect on the healthcare industry. Healthcare providers who made extraordinary pivots to their operations to provide quality care for patients throughout the pandemic are now facing decisions about their post-COVID and long-term strategic goals. With the repayment of government stimulus funds on the horizon, healthcare lenders may need to adapt their finances to accommodate the realities of a post-pandemic world. I'd like to have you join us for a candid conversation with leading healthcare lending experts who cover a variety of healthcare related industries and deals and sizes. We only have 60 minutes with you this afternoon, but we hope to take questions. Please submit your questions you may have in the Q&A feature. We will monitor those throughout the presentation and reserve a few minutes at the end of the webinar to answer those. This session is also being recorded and a link will be shared with you via a post-event email. It's now my pleasure to introduce our speakers today. Amy Heller joined Congressional Bank as the Senior Vice President, Healthcare Lending in 2013. Prior to Congressional Bank, Amy was most recently Managing Director at the Healthcare Credit Group at Capital Source Bank, where her responsibilities included originating, structuring, underwriting, and negotiating asset-based, leveraged, and real estate loan transactions within the healthcare industry. Her previous experience includes a variety of roles within Capital Source, Heller Financial, and its predecessor, Healthcare Financial Partners, where she managed various portfolios of loans, including complex restructuring transactions. Patrick Coffey is a senior managing director of healthcare capital at Ally Bank and is the head of healthcare real estate and healthcare asset-based lending. He is responsible for originating, underwriting, structuring, and negotiating complex debt financings to a diverse portfolio of healthcare companies, including acute care hospitals, skilled nursing facilities, rehab hospitals, and similar operators. Healthcare service providers and healthcare real estate owners, such as medical office buildings, are also served by Patrick and Ally. Patrick has originated and closed over $5.5 billion in healthcare transactions over the last decade. So if you want to read any further on their bios, you can click on a link in the chat and read that. So let's get started. Amy and Patrick, I'd like to welcome you. Please share with us some background on your companies and your lending portfolios and targets. Who are your ideal borrowers? Which healthcare verticals do you focus on? What are your target deal sizes and anything else you're willing to share? Amy, we'll start with you.
Thanks, John. Appreciate you having me and the rest of the Waller team. So I'm thrilled to be here. At Congressional Bank, we are focused on all verticals of healthcare. Predominantly, we've worked in skilled nursing, assisted living. We've worked in psychiatric and behavioral verticals, some home health care, hospice, and other ancillary service providers, and other, I would say, real estate assets. We provide both working capital on the asset-based side, and we provide real estate lending. We can be creative in our structuring of those financings and leverage points. And I would say, execution is key to our underwriting. And our loan size is generally anywhere from, I'd say 5 to 10 million on the small side and up to 60+ million on the heels of a recent capital raise that we completed, whereby we completed a private placement totaling $345 million and have substantially increased capacity to deploy.
Congrats on that capital raise. That's great.
Thanks, John.
Patrick, how about you?
Yep, thanks, John. Appreciate it. Appreciate you having me. So again, I'm at Ally Bank. It's a slightly under $200 billion bank, assets kind of across the different things. As John mentioned, I focus strictly on healthcare. The verticals in there is acute care, skilled nursing, senior housing, medical office buildings, psychiatric, and kind of the whole panoply, right? And for me, the group that I focus on is real estate and asset-based lending. We do all kind of healthcare services lending as well within Ally Bank. It's just not what I personally do. Transaction size, we're probably not anything below 25 million. And at this point, the largest deal we've done is a little bit over $500 million. So it's kind of in the range. I mean, if you looked at our average deal size, it's probably in the 60 to 75 $1 million, and that's aggregated across all different types of assets.
Right. I want to give our listeners a little bit of background, and then we'll delve into what you guys are seeing. In 2020, at least two sources of non-borrowed funds were made available to healthcare borrowers: PPP loans and Medicare accelerated and advanced payments. Healthcare providers received nearly $68 billion of CARES Act funds out of a total of $520 billion. In addition, about $100 billion was distributed to hospitals and other types of providers, 92% of which went to facilities that pay for inpatient stays, SNFs, and a few home health, hospice owners, and operators. Medicare advance payments accounted for increasing borrowers' cash on hand by 30 to 40 days on average. According to Moody's, some nonprofit hospital systems saw their median days of cash on hand increase to almost 44 by almost 44 days to 247 days. Some of the largest healthcare operators are certainly benefiting from the advance payments. HCA had $1.8 billion of cash on hand at the end of 2020, a 189% increase from 2019. Tenet, which had declining amounts of cash on hand in 2019, now has almost $2.5 billion. With all this money sloshing around the system, unsurprisingly, default on debt went down significantly. At the beginning of the pandemic, odds on default on healthcare bank debt jumped to more than 8%. However, as of March of 2021, with these government programs behind them, the probability of default on debt fell to less than 1%. So, Amy and Patrick, I'd like to hear from both of you on if anything has changed in terms of underwriting your qualifying borrowers. So, for instance, with the excess cash on the balance sheets, are you seeing that? Are there winners and losers as part of the pandemic economy? How do you factor in the excess cash? And has the government aid created any kind of false positive in the economy? Amy, we'll
Start and then feel free to jump in. So I would say, in the first instance, as we think about our existing portfolio of asset-based clients, many of them are flush with cash, either from Medicare advance payments, PPP loans, stimulus cash, what have you. And some of that, quite frankly, is going to start to have to be repaid to the extent repayable. The PPP, people are applying for forgiveness. They may not have already received that forgiveness. On the Medicare advance payments, they've already started recouping that money. So that is going to, take away some of the cash that people were flush with. And then I think that the last big piece is all the stimulus cash, which people are accounting for properly to the best of their abilities, at least in my opinion, with my borrowers. But there's a lot of unknowns as to how much of that stimulus cash can really be kept or will ultimately need to be returned to the government. And so everybody's really trying to wait and see. And while they are sitting on cash, I think most of my clientele has segregated that cash in a separate account to make sure that if they haven't spent it, that it's available to be returned. And then on the go forward, you know, when we're looking at new loan transactions, I think we're really taking a hard look at how successor liability might impact our new entity, if it's a new acquisition or something of that nature. As Pat's nodding, I'll let you jump in.
Yeah, no, I mean, not surprisingly, we do not have a dissimilar experience, right? I mean, we're certainly seeing, you know, that the Medicare advance payments being recouped, right? But we aren't seeing a corresponding jump in, you know, people's need for capital related to those financings, right? Because there is so much capital in the system, right? You know, one of the things, you know, as far as your underwriting question, right? I mean, you know, I think obviously, as we all know, healthcare extremely, you know, local specific, right? But, you know, on average, I think in the state of Maryland, right, like you have skilled nursing census down 13% kind of on average, right? And if you're talking about a 7% margin business, right, like I'm not a math genius, but there's an issue there, right? However, you know, there's been so much money pumped into the system. Has that system really percolated to the top yet? No, I don't think it has, right? And is it going to? I don't know, right? I mean, it's to Amy's point, right? Like, what is going to be recouped? What is not going to be recouped, right? You know, a whole another, you know, just can of worms. And John, you and your folks probably know this better than us, right? But, you know, what is the political risk, right? For the people that have, you know, received the cash and taken the cash, right? And, you know, you have a change in administration. Is somebody going to come after them, right? If I'm not mistaken, I don't lend money to HCA, so I don't have any, you know, private information, but if I'm not mistaken, HCA sent all of its money back, right? Precisely for that reason, right? Because they didn't want to take that risk. Now, there's plenty of people that are not in the position HCA is in, right? And they're not able to send that money back. And they desperately needed that money, and that money was extremely helpful for them. So, you know, we haven't seen it shake out. What I will say is all that money certainly served the purpose it was intended to, right? Is it held those operators over to kind of, you know, hopefully we're seeing the, you know, the end of the road here for the pandemic. And now, you know, we'll see if there's shakeout, right? Like, you know, certain, you know, and again, it's, you know, so industry specific, right? You know, we've talked about what's happened in the census for skilled nursing. Senior housing, right? You know, senior housing is probably the people on this phone call that are deciding whether or not we're going to put our parents into a senior housing facility. Well, you know, probably in the last 12 months, you know, unless you really, really didn't like your parents, you probably weren't going to do that because you were afraid of what was going to happen if that did happen, right? But, you know, we're certainly seeing that kind of breakthrough, right? I mean, we're you know, for the facilities that we lend to, you know, we're seeing census go up. We're seeing all those kinds of things happen, right? So, you know, where is the shake? My personal opinion is we haven't really gotten to the shakeout yet, and it's still to come, right? Because, John, to your point, so much money was pumped into the system. And look, quite frankly, it served its intended purpose, right? It kind of helped them survive. And right, fortunately, unfortunately, you know, some of our bars, they're right in the crosshairs of this, right? As we can, you know, pick up any paper and you realize that, right? And so, you know, in my personal opinion, that was an appropriate response, right? And it had its intended and appropriate effect, right? And what I am very hopeful for is that, you know, they don't now end up in a political trick box because they have accepted this money because they did what they were supposed to do. They followed the rules, and you know, we'd like to see that, you know, kind of them get the benefit of the bargain for that, right? Because it wasn't anything that they created, and they, you know, and they, as we can all see, provided an extremely valuable public service kind of through all this.
And I think they're all very grateful, Pat. I think that's, you know, key to this is people understand that they got this and they understand, you know, that they wouldn't have survived, but they're also trying to do anything and everything, in my experience, to make sure that they really are properly ticking in time and accounting for every last dollar spent so that there aren't problems down the road.
How do you all consider on when you underwrite a loan, though, that excess cash? Or I guess if it's a PPP loan, it should be recorded as a liability until it becomes forgiven. But
so PPP has to be repaid upon a sale.
Yeah. So are you all, though, kind of just discounting all that money and then kind of trying to figure out what the fundamentals of the business are? Or?
Sure. Let me give that a shot, and then Amy can correct me where she thinks I'm wrong. But
Always.
I think a conversation you would hear if you were sitting in our offices, right? And if we were sitting in our offices for that matter, right? Okay, what is the pre-COVID EBITDA? What is the post-COVID EBITDA? Right? And again, right, that money was intended to help with that, right? And so, it's not that it's totally discounted, right? But now what is the pathway? What is the likelihood? What do we see happening as far as getting back to those pre-COVID numbers, right? So am I just writing you a loan on the pre-COVID number? No. Am I just writing you a loan on the post-COVID number? No, right? But there needs to be analysis and some determination, right? As to where the right number is that, and that kind of, you can now jump into the argument, is it a art or science? But I would argue that's part of the art related to it, like trying to really figure that out, right? And again, it's so industry specific, right? If it's hospitals, how many beds are in the MSA? If it's senior housing, what does your capital stock look like versus other capital stock? What capital stock is coming online? All those different types of things, right? So hopefully that's clear as mud.
Clear as mud.
Yes.
Yeah, operator specific and very and owner specific and very product market specific. To Pat's point, if I look at somebody who's buying a portfolio of nursing homes in a state where they have historically operated well, and the only thing that happened was your occupancy went down and your expenses increased a little, but you've managed and you're doing the right things, then I feel like if you're acquiring the property, I should be viewing the ones you're acquiring sort of the same as your others from a general standpoint. If you're coming into this new and a new marketplace, I think that's tougher to underwrite.
Yeah, I agree. One other question we got is pricing. What kind of pricing are you seeing? Like compared to pre-COVID, is the pricing better, worse?
Pat and I were talking about this before we came in here. I think we both think, and I don't want to put words in your mouth here, but we're kind of back to pre-COVID pricing. The market is as competitive, I think, right now as it's ever been.
Do not disagree one cent with that.
We've had this recorded, okay?
Yes, yeah, no, exactly. Not dissimilar to the various providers, the banks are flushed with cash too.
Yeah.
Right. And everybody wants to put money to work, right? Yeah. And it's it's not super easy to do that right now, right? And what at least I'm hopeful to see is start to shake out here in the middle of the year. And because look, it's hard to land, it's hard to acquire, it's hard to sell when there's uncertainty in the market, and there's clearly uncertainty in the market, right? So for those transactions that are highly bankable, you can bet there's a lot of people lining up.
Yeah. Did you all see any people take the money, either PPP or the Medicare advance payments, and pay off their lines of credit? Or, did you see anybody do anything sort of what I call almost kind of aggressive in that regard? Or was it more just keeping it?
In order to not give, material non-public information, what I would say is, to answer that question, if you had $2.8 billion on your balance sheet, do you think you'd maintain a revolving credit facility balance?
Right.
Probably not.
No. Except for the unpaid line fee. All right. How about did you see any spectacular investments being made? Did that encourage some of your borrowers to, put some real money into some capital improvements or anything like that?
I think there were, at least, when I think about some of the transactions I worked on, I think opportunistically people got some good deals on stuff. I think, there was a period of time where we really had all this uncertainty. And, I think from the nonprofits and maybe some of the mom and pops in smaller chains, they were just ready to get out of the business. And of course, we've seen all the larger divestitures. And so that's created a lot of opportunity.
Yeah, I would say that not as much as I would have expected, John, right? Because it's interesting, right? I'll jump outside of healthcare for a second, but I sit on a board of a commercial real estate company, right? And they were talking, they had a board meeting last week, and they were talking about all these debt funds had raised billions and billions of dollars expecting to come in and buy all this stuff. And this is commercial real estate. So now we're talking about hotels, multifamily, office space, right? And they couldn't put the money to work. And so what they're doing, you have, properties in lease up. And again, this is non-healthcare, right? But properties in lease up that can't, get to Fannie, Freddie, or any of the agency stuff. And so they're literally providing those, like you have a multifamily that's 65% full, and they're taking that money. So that's debt funds, taking that money and putting it out at government rates, right? That tells you there was all these people that were thinking there's going to be all these opportunities. And I just don't think they materialized to the extent, certainly not to the extent I would have thought they would have. And maybe it just hasn't happened yet because of all the money that went in.
Yeah.
Right? So, for me, that's a wait and see.
Yeah.
Right.
Yeah. All right. Moving on then. What trends have you seen over the last year? So are there certain types of borrowers excelling, some that are not, just industry type trends like that? And any takeaways from last year where you can point to certain conditions that made some borrowers more successful than others?
Want to start?
Sure. So medical office buildings, I'll give you just, a couple data points, right? Like they have performed exceptionally well, right? And if you think about it, in a medical office building, you have like outpatient stuff. So all these things that got hurt by the lockdowns, right? All the elective stuff that you couldn't do. But, they did, and people went out and they offered lease modifications and they did all this kind of stuff. And what we didn't see people really accept those lease modifications, right? They just continued to pay their rent. Right? Like the level of the acceptance of that kind of stuff. And that just tells you, the quality of those types of assets, number one, right? Obviously, to Amy's earlier point, right? But, they manage their business appropriately, right? And so, if you have, a big doctor's practice and you have, a bunch of different office space and different office buildings, right? So maybe you're not taking distributions, but, you're still doing enough, non-elective stuff that, you're at 110%. So you're still paying your bills and doing all that kind of stuff, and you'll catch up on the other stuff afterwards. Obviously skilled nursing, senior housing, you were right in the vortex of everything, right? And, so you did, there was clearly, you were caught in all the tailwinds, all that kind of stuff. And so, there's clearly significant effects on their business, right? But
We are starting to see some improvement. Yeah. The charts are showing, marginal improvements in occupancy and seniors and skills. Sure. So,
yeah,
we're cautiously optimistic there.
But, again, right, not to harp on the same point, but that money came into the system and the money had its intended effect, right? Yeah. And it helped them kind of navigate those waters. Now, clearly, if you were a little bit more sophisticated, you probably had an easier time navigating some of this stuff, right? If you're a little bit more conservative, how you approach some of this stuff, you probably had an easier time navigating some of this stuff, right? But, for the most, we haven't seen, at least I should say, I haven't seen, the big explosions or the big problems or all that kind of stuff. And, again, I feel like I'm a broken record, but the thing that concerns me is it is still the political risk related to it, right? You can pick up the New York Times any day and there's a story kind of aimed at the industry, painting it in a bad light. You can see Elizabeth Warren, or you can see, Elizabeth Warren calling people out like this private equity ownership and all that kind of stuff, right? And, listen, that has not been my experience, right? That's not, you go into those facilities, you would want to be in those facilities, right? And, so that's just, that concerns me, right? And especially because it's a risk you can't box in any which way, right? And it's, for me, I just worry about it, but I guess I'm a lender, I'm supposed to worry.
Yeah.
And you got to lend to the right people.
Yep, absolutely.
Yeah. All right. We got a question. Could you talk about what COVID-related EBITDA adjustments you're seeing? Or are you seeing any?
Adjustments, I don't want to think like adjustments. It's really just trying to adjust the proper stimulus cash out. PPP is PPE, sort of a minimal expense at this point. I don't think you adjust it out because I think it's ongoing. So it's really trying to normalize the effects of COVID on the business.
Mhm.
Right, no, I don't disagree with that, right? That was kind of what I was trying to get to with kind of the pre-COVID EBITDA, post-COVID EBITDA, and then trying to determine, all right, well, I got to normalize this, right? Like post-COVID is not the normal, right? And is pre-COVID the normal, or where in between do I think that normal is, right? And, because look, I mean, nobody in their right mind is going to volunteer, say, I want to go into a skilled nursing facility, right? You end up in a skilled nursing facility because you have some kind of major surgery and you need a recovery, you got into a car accident, you have, significant comorbidities, those kinds of things, right? And so when the economy shuts down, that your intake source reduces, right? And so you're clearly going to see that effect. And so for me, it's really a determination of trying to figure out how you're getting to that. So is that a COVID adjustment? Yeah, I think it is a COVID adjustment. But where exactly you're getting to that, it depends, right? To give you a John Tischler legal answer, it depends.
And John, just to be clear, what Pat is really trying to say is it's all a guessing game, and he has absolutely no.
I do not agree with that statement. I think that's a correct statement.
Well, I mean, it is almost impossible for us to know, right? I mean, and that kind of leads us sort of to the next question. What do y'all think the future holds? What do you anticipate? When do you anticipate things coming back to a normal state? Any trends you're going to be watching over the next 6 to 12 months? And of course, now we've talked about it, but the loans and advances by the government, they'll have to be returned over that period of time. What effect is that going to have on things? And what allowances are you thinking you'll have to make in connection with any of the repayment plans that the government is putting on your borrowers?
So I think there are a lot of different things in there. In terms of, what does the future hold? It's hard to say, right? I think we've seen the government, talking about putting a lot of money towards home health, and that's clearly going to be a big push in the government. And so I think that, we're going to see a lot more there. I think we started to see them. We're going to see a lot more of these PACE programs. And really, a shift towards continuing the utilization of telehealth that we started during COVID. I think we've proven to ourselves that technologies are there. They can be used. They can sometimes be used in tandem with traditional skilled nursing facilities, assisted living facilities, but really, or other types of providers, but used to supplement some of the care. So I think we're seeing advancements in technology much further than we could have expected.
Yeah, no, and I agree with that. And the other things, so specific to various industries, what would I look for, right? Skilled nursing, right? I want to see census start to come back, right? That's going to be the biggest thing. And as the economy opens up and all that kind of stuff, I think the answer to that is yes, right? I think people not in the industry are like, well, they're going to move these other things. I'm like, again, I get back to the point I made a second ago, is that like, people don't end up in a skilled nursing facility because that's where they want to be, right? Senior housing, a different story, right? So senior housing, what I want to see is, you've had, a lot of construction, right? And again, it's very, very specific to that, those neighborhoods, right? So, one neighborhood may need more construction. One neighborhood may have way too much construction, right? And so you had, construction happen, you have facilities come online, they're going to be way behind on their fill-ups, right? Are they going to be able to fill up, right? And you haven't seen the market adjust to those yet, right? Because there's been money in the system, right? Now, senior housing didn't get the same amount of money that, other places, but they did get money, right? And so, people aren't going to make that adjustment now, right? But, we're certainly seeing senior housing transactions getting done with, stabilized facilities and all that kind of stuff. But the real question for me is what's going to happen with the fill-ups, right? And is there going to be more room left for them, right? Hospitals, something totally different, right? I mean, hospitals, my experience was, you watch the news and, every hospital's overflowing and there's no place to put everybody. At the same time, you have hospitals laying people off because they're empty, right? And, you know, there was clearly a big disconnect there, right? So hospitals, you know, as the procedures come back, right, you're going to be hiring, you're going to be doing all that kind of, so your expenses are going to be going up as that happens too. You know, medical office buildings we already talked about, right? I mean, I think, you know, psych, right? You know, like you lock people in a house for 12 to 18 months, right? There's probably going to be a higher need for psych, and there was already tremendous need. Yes, exactly. So, you know, I think, you know, very, very industry specific on the different, you know, the different types of assets, at least that I focus on. And so I think there's going to be a lot to kind of monitor as we kind of come through to the next. And I think, you know, as that money is, you know, draining out of the system, right? I mean, again, the money did exactly what it was supposed to do and got kind of people through it. And now, you know, we'll start to see what starts to shake out.
I will say to one of your points though on the fill up of assisted living and other
Yep.
seniors products, I think one of the benefits of COVID was that there weren't as many new construction starts. And so, you know, to the extent that occupancies declined or things were to fill up, you know, there's probably a little bit less product in the market. And then I think we're seeing less in new starts as lumber prices are where they are. We're doing a couple of projects, but
Listen, you tell me like that, like
it's
a piece
crazy.
of plywood was like, they gave me a price for it, I was like, what? But, nuts.
Yeah, but with the cost of lumber, I think that is slowing some people's
Yeah.
projects.
This is kind of a curveball question, but you know, retail got hit really hard. And so you have lots of retail space that's potentially empty. Do you see any of that like maybe being repurposed for, you know, any sort of healthcare?
The stuff that I focus on, but you know, where I've seen that used is like adult daycare, you know, those kinds of things are kind of fun, but you know, obviously you're going to need to take over that entire spot because you're not going to have a gap next to the adult daycare center, right?
Right.
You know, you know,
But you can have a shopping mall, for instance, that just gets completely mothballed. You can
Yeah.
take that shopping center and make it a medical mall.
Yeah.
do that. And I saw that Amazon is looking to purchase a number of disused shopping malls.
Yeah, I mean, it's going to be interesting how some of this just sort of percolates through the whole system. You know, all these changes that have happened, it's going to take probably a couple of years to kind of all shake out completely before we
I
see
don't
it.
think there's any, you know, as far as what is actually going to shake out and how it's going to change it for the long term, my humble opinion, we're in the first inning of that, right?
Yeah.
You know, because we've kind of, you know, we plugged the dike, right? But we haven't fixed the whole dam yet, right? And so we stalled it, and now we're, you know, as things start to come back to life, we're going to see what the shakeout is, right? You know, clearly, if you want to bend the cost curve, you got to take people and put them in a lower point of care, right? But you know, that's great. You want everybody to be at home, right? But you know, you're talking about it's severely acute people, right? Like it just it doesn't, you know, and maybe I don't understand it, right? But it doesn't seem to make a lot of sense to me, right? I mean, I understand, right? It absolutely would be better if we could have it at home, right? But you know, America, you don't have like these big multi-generational households where, you know, you traditionally see that, right? And you know, it's not that easy,
It'll
right?
be nice for a one-off, but I think what
Yes.
you saw, right, and what we've seen with our providers is, you know, somebody waited to send mom back to a facility until she could get her shot. She's gotten her shot. Not only does somebody want to get rid of mom because, you know, it's a lot to take care of her and maybe they're going back to work and their kids are going back to school and what have you. Mom wants to be back socializing with her friends in that facility because that's where they are and she's been starved for actual relationships. So I think it's sort of, it's all of it where, you know, when it's optionality for assisted seniors, what have you, people are wanting to go back. The tours are improving, you know, in terms of numbers and move-ins and what have you. And skill will always be need-based. But, you know, to Pat's point, it's just not logical or practical to assume that suddenly we're going to shift to all home health. We don't have providers. We have hard enough time finding people to work in skilled nursing facilities. Where are we going to find them to do home health?
Yeah, it just, just a pure economies of scale,
Yeah.
right? Like,
Yeah.
disaggregate everything. I understand the attraction to that, but like, I just don't, I don't see it as practical, but I'm just a lender, so what do I know?
No, yeah. I mean, well, and you see that the minimum wage is being raised a lot, and that's going to impact the ability of providers to compete for people as well. So, Rick Aerosmith sent us a question, Pat. So
Excellent.
even if you have a reduced census, you will underwrite to a different pro forma, potentially higher stabilized rate based on 2019 question mark. So I think he's asking, even if you have a reduced census, are you going to underwrite to a different pro forma, maybe even a potentially higher stabilized rate than what you saw in 2019?
Wait, is it going to go above what 2019 was? That's probably how first of all, Rick, good to hear from you. Hope you're doing well. Yeah, is it going to go back higher than 2019? That's probably highly doubtful, right? But I guess my point, maybe I didn't make it very clear, right? Is, if my, kind of stabilized pre-COVID, right? And then my post-COVID, right? Which can be monumentally different, right? Am I going to penalize you all the way down to this post-COVID? No, right? And probably if I did, there probably wouldn't be a transaction there, right? Because you couldn't lever it up enough, right? But am I automatically just going to say you're at 2019? No, I'm not going to say that, right? But I'm going to say, okay, to Amy's earlier point, right? You're starting to see people come back in, right? All right, so we had 3 move-ins, last week or last month, right? Is that sustainable, right? Do I feel good about that, right? Is that consistent with what we saw pre, and those types of things, right? So, maybe what you can do, right, is, look, I can get you to this level now, that's, somewhere in between those two numbers, and I'll earn you out for, the rest as it's kind of coming back, right? So I think there is a desire to be flexible with that at the time, trying not to be stupid about that.
Yeah.
It's always a huge struggle for me.
You said it. No, but I think Pat's absolutely right. Like, I think you really look, and hi, Rick. I don't have to ask how you are because I actually speak to you from time to time. But no, I think you really have to look at 2019 as your baseline. 2020 is, this is what happened. And in 2021, what are the trends telling you? And maybe you buy the story, but you don't want to take all that risk. So maybe you ask for increased guarantees. As Pat said, a release of money through earnouts. Maybe it's reflected in, some combination of rate. There may be some debt service reserves that we hadn't historically asked for. I mean, it's sort of the full gamut, but being creative to understand your client's needs and then get you to a transaction, which I think we both.
Yeah, absolutely.
Is there any particular product that you all have that you have the most demand for? Like right now, is there something really popping, either industry wise or, type of loan or anything like that?
This one, there might be some divergence, right? For us, it's, it's an ability to write a multi-$100 million check because there's not that many people who would do that, and we will do it. And in the right situation, we'll do it, and we'll take syndication risk related to that, right? And once you get, for us, right, once you get into that playing field, there's been a bunch of people eliminated at that point, and so that would be a competitive advantage for us. As far as, again, we're still, waiting to see some of the shakeout from, the various, the different things that happen. But
yeah, I would say a lot of what we're seeing, interestingly, is some of the stalled lease ups. And with the right sponsorship and the right, companies, we're really, we're liking what we're seeing. We can get paid a little bit more. We're willing to go a little higher on the cap stack than traditional banks. So if we believe in the operator, we believe in whatever kind of recourse we can get, perhaps from a fund or otherwise, you can underwrite to that stall. And even better if it's a portfolio of multiple properties.
Yeah. I mean, one thing that from the legal perspective that we see is a lot of M&A activity because the threat of a higher a higher tax rate in 2022 seems to be driving a lot of activity. Is that something that you all also are seeing? And is there like some consolidation going on, or can you tell?
Know that I've seen anything that's been tax planning wise. It's been more sort of COVID at this point.
Yeah, no, I can't say that I've seen a ton of that, John. You know, I mean, certainly, you know, you have a few people picking their spots and stuff like that, but I haven't seen the, you know, kind of driven by the, you know, the impending tax changes. I haven't seen that yet. But maybe just because I didn't see it, I don't know that, but
yeah,
I don't have a sense for that.
So, you know, we're going to kind of close this down, this portion, then we'll see if there are any other questions out there. But how would you like to kind of close, kind of what's your final thoughts on what the future may hold and where things are going to be headed? And
Sure.
one thing I will ask both of you, because, you know, what I do and some of the others I noticed that are on our feed is, you know, what about default? What about the other side of the lending coin too? You know, what do you predict in that regard?
Sure, I'm happy to take the first stab. You know, I mean, I think that, you know, we continue to remain, you know, just energized by the healthcare space, you know, and we are really excited about the opportunities that are going to come. You know, again, not to be the broken record, right? Like we're clearly expecting there to still be some shakeout related to it, and you know, I mean, I think that all the money that's been pumped into the system has kind of pushed that down the road a little bit. And you know, if I knew how all that was going to work out, I probably would not be sitting on this webinar, right? I'd be hanging out with Jeff Bezos somewhere.
Right.
But you know, clearly there's going to be there's going to be some shakeout related to that, right? And you know, I mean, I think it's going to create a lot of opportunities, right? I mean, you know, look, healthcare is almost 20% of the GDP, right? And so it's a good spot to be, right? And we're very excited about, you know, some of the opportunities that we're seeing, you know, and you know, look, we're energized and looking forward to what's to come. You know, as far as the defaults and all that kind of stuff, you know, I mean, I don't think you're seeing a ton of that through the industry at this point because, again, there's so much money has been pumped into the system, yet you don't see that right now. As that money is draining from the system and as some of that money is recouped, right, you're going to start to see that, you know, percolate a little bit more, right? And that, you know, quite honestly, is going to provide probably opportunity for every single person on this phone call, right? And so I welcome that and I look forward to it. And you know, I mean, as far as like our portfolio, it's very well positioned. We, you know, there's not issues related to it, so we're, you know, we're in a good spot. We're looking to be aggressive. I'll leave it at that.
So I'm going to sound a lot like Pat here, you know, in sort of where we
So
are.
smart then.
Very smart. Also very good looking Pat. But really, you know, we're seeing a lot of the same things. You know, our credits are very stable. You know, we're very proud of all the things that our operator and owner partners have done. We think that, you know, the tremendous work that they did sort of, you know, got us to where we are. You know, in terms of future opportunity, I mean, we started out talking about our capital raise that we just completed. And certainly, you know, part of the purpose of that was to continue to grow our portfolio, you know, in all areas of healthcare. And, you know, we can do so with creative structures and, you know, creative financing solutions. Certainly, I can't speak to the hundreds of millions of dollars that Pat speaks to, but we do have increased lending capacity and plan to deploy to all areas of healthcare. And I agree on the defaults. You know, we're not seeing them yet. I think they'll happen, particularly as, you know, some of this money is repaid to the government, and as you know, people sort of, you know, run through what they received. So I do think we'll see it. We're just not there yet.
All right. So if any of our participants have questions, please use that Q&A box at the bottom of your screen and type in any questions you'd like to have Pat and Amy answer for you. First one we got is, do you guys see any non-public REITs looking at SPAC executions?
Outside of my knowledge base, so
I have not seen a lot of non-public REIT action at this point, right? I mean, I think, it's one of the things that, the level of activity there is not what it once was. And so, it's a really interesting question, but, I haven't seen it.
Let me take a riff on that for a minute. What about REITs that may have difficulties, with the returns that they are obligated to get? If they can't get those returns, do you see them kind of breaking themselves up? And is there going to be a new ownership structure for, some of our senior living chains and that sort of thing?
I mean, I think what you're seeing is, different REITs, different, you have seen a lot of repositioning from the REITs, right? Whether, some of them are getting out of skilled nursing. Some of them have split their skilled nursing portfolios off. Some of them are, you see a lot of them moving towards medical office buildings, and you see, right? So they're clearly, look, I mean, obviously a very dynamic ownership model, right? And so they're going to chase the returns and they're going to chase the portfolio performance, right? And so, they're kind of going where, the portfolio has performed, right?
Yeah.
And I think the REITs specifically, right? I mean, I think some of the REITs felt like they were getting tremendously undervalued because of certain of their types of exposures. And as a result, they then disaggregated some of that to try to unlock some of that value. And then I think COVID hits and, now people are like, batten down the hatches and let's make sure we, let's conserve our cash. Let's do all this kind of stuff. And now, it's, the sun is starting to peak on the horizon, right? And hopefully that continues to rise up and you're going to see a lot of that kind of, the animal spirits, as it were, unleashed. And, it would be great for me. And I'm sure it'd be great for everyone on this phone call.
Yeah. Do you see any potential roll-ups in any particular healthcare industry coming out of all this? Anything different than what's been happening prior to the pandemic?
maybe some of the home health companies.
Yeah, I don't know that there's anything specifically different, right? I mean, clearly if you're a private equity shop, right, you're trying to figure out where's my home health exposure, right? And if I don't have any, why don't you have any, right? And that kind of stuff, right? There's clearly that's going on in different conference rooms around the country right now. There's no ifs, ands, or buts about that, right? Whether any of that is specifically related, I mean, I guess home health you could say is specifically related because of what you see in the news, right? But look, I mean, I think that people are clearly aware of the, and I guess go off on a little bit of a tangent, so I apologize, right? One of the things that you see if you're sitting in a large bank, and this is not Ally specific, this is banks in general, if you had commercial exposure, you had, all different types of real, you had, multifamily, you had office, you had hotels, right? We may have been in the center of the pandemic, right? But I would argue that the performance has been significantly better. And now that's clearly got tailwinds related to, all the money that came into the market, right? But, why did the money come into the market there and not go to the hotels? Because people know that it's the safety net and you have to have it, right? And so now if you're sitting and, if I'm Jamie Dimon and I'm looking at them like my hotel portfolio is not looking so great, my office portfolio is not looking so great, hey, my healthcare portfolio looks pretty good.
That's okay.
Let's put some more money over there, right? I mean, clearly, that, it doesn't take a genius to figure out that that's going to happen, right? But that's not a that's not an Ally thing, but bank money center banks in general, right? That's clearly going to be, look, I mean, it's a simple math problem, and I'm
Yeah.
pretty sure my fifth grader could figure that math out.
Right. Okay. Well, I don't believe we have any other questions, so I'm going to thank both of you for a great 50 minutes that we have been talking, and really appreciate all of your time and everybody on this. So on behalf of our speakers, thank you for joining us today. We hope you found the webinar to be worthwhile. We will be sending a post-email communication that has a recording of today's webinar. So everyone, please have a great day. And thank you, Pat, and thank you, Amy, so much. Really appreciate it.
Thanks,
John.
Appreciate it.
Thank
Hope to see
you.
soon.